welcome to the first episode here. Now, this just came to mind last night, looking at the videos and the pictures of the travesty out in California. And something I heard throughout my career was I had no idea about this coverage. Thank you for explaining it to me. So if this helps one person, it's worth 10 to 15 minutes of my time. Now, there's no subscribers here. I don't have any base whatsoever. So I don't imagine this is really going to hit a lot of people, but it could be a year from now that you see this. And it's really important that you know what's going on. Toward the tail end of my career, more and more we saw people purchasing policies online or 1-800 number. That's perfectly fine. The thing is, though, that can become really dangerous if you don't have the right representation. So when there's a problem, and that's the thing about insurance companies, their commercials, it pisses me off because when there's a problem and someone's crying at your desk because their kid is laid up in a hospital bed, it's not fun and games anymore. When you don't have a house to live in anymore, it's not fun and games. So these stupid ass commercials, it's just ridiculous. So let me just give you what's happening here. The main thing you want to do is get a copy of your declarations page. Now, most insurance companies have apps. And within that app, or just use the web browser on your phone, you can get a copy of the declarations page. And the first coverage, you'll see a bunch of different coverages, and we will go through it. But the one coverage I want to talk about is coverage for loss of use or additional living expenses. Now, quick background, if I didn't, I don't know if I even said this. I was in the business for 20 years. I'm still licensed here in the state of New York. We sold the business roughly 4 years ago. But again, I still retain the licenses just in case if I ever get back in the business and that sort of thing. But I did this for 20 years, long hours, so I know this stuff inside and out. I promise I will help you. So for additional living expenses, what this means is what the insurance company will pay for you to live somewhere else due to a covered claim. So fire is a covered claim. There's nothing to talk about. But what becomes interesting is the type of policy you have. Now, in my experience, the older the policy, the better you are versus the newer policy. And this is probably a third of the reason why I left the business, because over time, the insurance companies would just give you less and less and less and less coverage. And it infuriated me because I'm the type of person, I'm not going to recommend something to you unless I'm willing to buy it myself. And with these older policies, typically you don't have a dollar cap for additional living expenses. So it may say, for example, up to 12 months. That's your additional living expenses. So we'll pay for you to live. It could be something like an Airbnb sort of situation, a short-term, what they call short-term housing. No dollar cap will pay up to 12 months. On these newer policies, meaning maybe the last 15 years, certainly within the last decade, without a doubt, they changed that. And now they gave you really two coverages. One was a dollar cap. The other one was a time cap. So it may say $80,000 or up to 12 months. So what that means is whatever hits first. We're going to pay 80 grand. Once we hit 80 grand, we're done. However, if we hit 12 months first, we're done. That's what that means when you see that coverage. Now, if I'm missing anything here, again, I'm licensed in the state of New York, but I imagine everything has to be pretty darn similar in California. You know, there may be different nuances, but for the most part, home insurance is home insurance. So if I'm missing anything here, please leave comments. I will respond, and if I can help, I'll make more videos, I promise. But that's what that coverage is all about, okay? So that's really important because where are you going to live? Well, it's on there. It's on your policy. And then toward the end, I'll talk about what probably is going to happen in terms of more assistance, at least what I saw here regarding hurricanes. So I imagine in this kind of this disaster, you're going to get more coverage anyway, and I'll talk about that in a second. So, but going back to the declarations page, the very, 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 very first coverage is called dwelling. Dwelling is the physical structure, okay? Physical structure. You can't pick it up and walk out with it. That's a different coverage. So dwelling is the physical structure. You're looking at the house from the outside, that's the physical structure. That's the dwelling. And you'll see a coverage amount. Now, this is where it becomes interesting. If you have a mortgage on your home, chances are you have what's known as a replacement cost policy versus actual cost. We never sold actual cost in 20 years, never once, because actual cost means depreciation. So in other words, if your coverage on your home is $500,000, that's the max they're going to pay, but when there's a loss, they're going to depreciate the payout. So in other words, your house is 70 years old, the siding was 25 years old, the roof was 18 years old, and they start depreciating things. That's garbage. We never did that. Replacement cost, which is what most mortgages require. So when you purchase a home, I'm sure as you remember, before you close, you need proof of homeowners insurance. 98% of homeowner or mortgage companies want replacement costs. So on our end, we would have to show proof to the bank that this is indeed a replacement cost policy. Okay? So chances are you have replacement cost anyway. If you have a good broker, you're very likely have replacement cost. So what that means is we're going to pay the value to rebuild the house. Now, replacement cost on our end, we have a calculator. So in other words, what year was the home built? What's the square footage? How many stories? How many bathrooms? Tell me about the interior. In other words, do you have carpet, hardwood flooring? Do you have drywall? Do you have plaster? All of these things go into a calculator, and then it spits out a replacement number. Now, this number is not the market value. So when you see the dwelling coverage on your policy, you may be thinking, holy cow, this is not the market value. Don't worry about that. Home insurance is only the construction value. So imagine if you took up your home and slammed it in the middle of Kansas. The market value is completely different, but the construction value is pretty much the same. So that's all that home insurance is, the construction value. So don't go crazy about market value. So once we put in everything into this calculator, it spits out a number. Then as a backup, an inspector goes to the home, typically within 2 to 3 weeks. They measure the house. If you have a high coverage, they'll even do an interior inspection, but for the most part, it was just the exterior. And they also check to make sure, there's no trees about to fall in the house, you don't have holes in the driveway, you're not missing handrails. But the reason why the inspector goes out there is to verify you have enough coverage to rebuild the house. So that's all it means. So dwelling is, for the most part, you probably have replacement cost, which means you're pretty much guaranteed to have the same house rebuilt. That's really what it means. Then on top of that, most insurance companies give an extension. So maybe 20 to 25% above the dwelling number. So on our end, we always gave the extension because it was so cheap. It was like maybe, when I say cheap, I'm talking like less than $20 a year. So if the coverage is $500,000 on the dwelling and you have a 20% extension above that amount, then you're getting another $100,000. So the total would be $600,000 per loss for the dwelling, okay? The physical structure. So that's all that dwelling means, the actual physical house. Next coverage is coverage B, that's other structures or detached structures. So that's your fence, you have a detached garage, you have a pool, anything that's not attached to the house. So if there's a loss and the house is burnt down, the dwelling coverage is for the structure. Then regarding their fencing and detached structures, that's the next coverage. Now, typically it's 10% of the dwelling. So if you have $500,000 on the dwelling, you have $50,000 coverage on the detached structures. All of this stuff is really important because in my experience, it wasn't so much that the insurance company was jerking someone around. It was the adjuster who was a complete idiot. So that's the difference, why you want to know these things. Maybe kind of boring, but God almighty, just know these things because it's so crucial. So dwelling, detached structures, and then the next coverage, which is coverage C, is personal property, or it may be listed as contents. Contents is your physical belongings you can pick up and walk out with. Okay, so it's not, again, you may be thinking $500,000 is not enough because I have so much stuff inside the house. Don't worry about that because now you have coverage specifically for your belongings. So furniture, electronics, silverware, clothing, all of this stuff is known as personal property. Now, for the most part, it's at least 50% of the dwelling. So if you have 500,000 on the dwelling, you have 250 on the contents. Now, the other thing to note, a couple things. Well, if you may have replacement cost on the structure, meaning no depreciation, but you may have depreciation for your contents. That's up to you when you first purchased your policy. I would say maybe 50-50 is what I came across. My main concern was the structure. The way I see it, you need to have your house if something happens to it. People were sort of funny regarding personal property. Some people just had some really old stuff and they could care less. My couch is 12 years old. I don't care. Computers are cheap. I don't care. It's like they have no silverware from the great-grandparents, nothing like that. So they were perfectly fine with a depreciating number on the personal property. But so what that means ultimately is I think it's going to be more streamlined in this kind of disaster. But if, let's say you just had a fire, and when you submit the claim, eventually you're going to talk about what you had. And if you start saying, well, my computer's 4 years old, they won't give you a brand new computer. They'll depreciate that amount. And that's what you get paid for, okay? Your couch is, like I said, 8 years old. How much did you pay for the couch, roughly? I don't know, $2,000. Okay, well, we're going to depreciate that over 8 years. Now, what I always recommended is to get a fireproof safe, and keep a log of everything. Put it on a flash drive. Better yet, get a safety deposit box. So they call safety or safe deposit box at the bank. Just something to securely keep your stuff in. Most people won't have that, and like I said, I can't think of one time where the insurance company really gave them a hard time that they didn't have receipts, but it just makes things easier if you have stuff, or just take pictures of what you have if you can. The other thing we used to always give out when someone purchased a policy, I would mail it to them. It wasn't even like a PDF file. It was a pamphlet that opened up like an accordion style, and it was a really nice pamphlet because it had space for a living room, and you write in what you have: kitchen, dining room, bedroom number 1, bedroom number 2, and you would write in everything you have and approximately what you paid for it, and you kept that in a safe place. Keep a copy at work, keep a copy in your car, who cares? Keep it somewhere, keep it at your parents' house, keep it at a relative's house. And if something happens, that's golden, because it just makes the whole process easier. Okay, then the next coverage is your additional living expenses. That's if you have to live somewhere else. Then you have coverage for family liability. That's if someone sues you. An example, I can give you an example. When I was a kid, I threw a football through someone's window, and my father put in a claim to replace that window through the home insurance policy. You wouldn't do that today, because if you put in 2 claims, they'll non-renew you. But nonetheless, that's an example of liability. And then you have coverage, at least in New York here, for guest medical, which means you have someone over the house and they fall down the stairs and they break their leg, break their ankle. That's covered up to, typically it's like $5,000 a person. But that's your basic policy. That's your basic policy. And I'll give you my word, if you guys have, anyone watching this, you have any questions, and if it's something I can quickly answer, I'll just type it in. If it's something that requires, which a lot of times, especially in insurance, it requires more of a background or more explanation, I'll just make another video. Just keep on going here. Something I would often get questioned is, do I have to pay more than one deductible? And the answer is no. You pay your deductible based on the loss. So if your loss, what's today, the 10th? So let's say on January 8th, 2025, you lost your house due to a fire, you're paying that deductible, period. So if your deductible is $2,500, you're paying $2,500, and that's it. There isn't a separate deductible for all these different coverages. You just have one deductible. Now, on the flip side, here in New York, this is something that never existed until probably the mid-2000s, and that's a hurricane deductible. So I don't know, you guys tell me if you have something. Is there a fire deductible? I have no idea. So what that means is, here in New York, if you're too close to the water, you have typically a 5% hurricane deductible, meaning your deductible is 5% of the dwelling amount. So if your dwelling coverage is $500,000, 5% would be 25 grand. That's your deductible. It's a huge deductible. Now, going back to what I was saying earlier, years ago, we had a hurricane. I don't even remember the name of it, to be honest. And the hurricane was so devastating and almost surprising that the state of New York, they issued a statement stating no insurance company will be allowed to charge you a hurricane deductible. So they sort of came in as a savior in that case. But I imagine something very similar is going to happen in California, just based on what I'm reading about the federal coverage, and it's such a immensely rich state. I have to imagine, and it's incredibly consumer driven, like New York State is, overly bureaucratic and all these departments you don't need. But ultimately, I imagine you guys are going to get some leeway regarding that. But hopefully you don't get jerked around too much regarding the insurance company. So this is why, if you have to watch this 5 times, I know it's not exciting, but if you have to watch this over and over again, understand your policy, understand the coverages, because all it takes is some jerk off who just started. Because what happens with these large losses is the insurance company somehow hire these short-term adjusters. And some of these don't have 2 nickels to rub between their ears. They just don't know what the hell is going on because they're so bombarded and they really don't care, some of these adjusters. And this is when you're golden. If you have good representation, that's when you call your broker and say, hey, I'm being jerked around. And we would get on the phone. And typically it wouldn't be with the adjuster, it would be their manager. Hey, what's going on here? This is unacceptable. They're covered for this. And if sometimes it would be like a gray area, and I would find the policy jacket. On page 46, clause 2, it says this, and it helped. It helped. There was a couple of times that, not everyone knows everything, but when you're focused on something, a day in and day out for 20 years, you know this stuff pretty well. So my advice, get the policy once everything calms down, right? Everything's just too crazy now. But, 2 weeks from now, get the policy. If you don't have it, the insurance company, even if you have an older policy, they can get it from archive. So they may not even have it on file. They may have to archive it. But if you have a local broker, go to their office, because we kept every pamphlet for every policy, and we had numerous copies of them. So I would just hand them out, and or I would send PDF files showing, go to this page, and this is where the coverage is, because don't take my word for it. There it is, and attorneys wrote this. You're covered. So. Good luck to you. Thank you for watching. Hope it wasn't too long, too much of a rant, but thank you for watching.